Hello and welcome to another episode of BFRR, our Bitcoin, Fiat and Rock and Roll podcast, where we explore the intersection of traditional finance, digital assets and digital currencies and help you to understand how digital money and assets will evolve in the future. Yeah, March has already come to an end. It's time for another news episode where we look back into the most recent updates and news over the last weeks. And on the agenda today, we have a couple of very interesting topics. Who is we? It's myself, Manuel, but also Alex, who joins from St. Gallen. Hey, Alex.
Hi, Manu, and I'm actually joining from Frankfurt, but still Europe, since you're in Asia, so kind of a late afternoon thing for you or afternoon thing for you and a very early morning thing for me today.
That is true. You've had a couple of good days, I think, in Frankfurt at the Crypto Asset Conference and the Digital Euro Conference. Maybe we'll also hear a bit on that. But yeah, the focus in today's news episode is really on the infrastructure, because there have been some recent interesting updates on the infrastructure that TradFi players might use, whether it's continue to be used private permissioned blockchain or whether we see a shift into public permissionless infrastructures. Then also some noticeable regulatory developments and also recent developments in the continued momentum facing stablecoin industry. So yeah, without further ado, let's kick it off with a quick market update where I also want to provide a short overview. So in general, the turbulent capital market developments continued in March. We saw in the second half of February a strong sell-off in assets, especially risk-on assets, including cryptocurrencies. So the whole market cap of this industry declined and continued to decline in the first half of March. So from an all-time high back in December, 3.7 trillion, it went down now to roughly 2.8 trillion, so a significant decline. And we've seen that clearly also in the price of Bitcoin, where throughout March, the price experienced quite strong volatility. It traded between 85,000 and 90,000 roughly. And after all the tariff announcements of the Trump administration, so strong effect continued from macro, here the sell-off continued. And there's clearly also a continued strong correlation between risk-on assets, so tech stocks predominantly, and the crypto sector, and especially the Bitcoin price. So when tech stocks fall, we currently also that Bitcoin falls as well. Yeah, and most notably, a couple of weeks back, Trump announced the US Bitcoin reserve or the crypto reserve. And we will actually record a dedicated episode on this. Alex, I think you and Jonas have already prepared something here. We've started already with 2 episodes, one pro and one contra Bitcoin Reserve with Frank Scheffler and Jürgen Schaaf. We hope you have already listened to those. We can also put those in the show notes again. But yeah, let's keep it short here on this one. This was clearly the most notable news in March on the Bitcoin Reserve, where Alex and Jonas will have a deep dive.
Yeah, the one with Frank Scheffler is unfortunately still in German, but the one with Jürgen Schaaf from the ECB is in English, so available to everyone here. And what we did during these episodes was rather, let's say, sitting back, letting the guests talk, right? It wasn't really let's say, no super tough questions from our side. So Jonas and I thought it would make sense to maybe have another episode that puts those 2 views, pro and contra, into a perspective, and we are going to share our opinion and summarize the arguments. Again, I've also written an FAZ article on that topic. I usually translate these articles also into English. You will find them on my website on the Bitcoin Reserve.
Yeah, we'll put those in the show notes as well. So look forward to such a deeper dive episode from Alex and Jonas on that topic. A quick wrap up on the ETF flows. So the first half continued the significant outflows that we already saw in February. There was only in the second half of March some inflows again, but in general, as we described also last month already, there's significant outflows from these ETFs again, which is quite interesting, right? Because even though the public administration in the US, as you are all familiar with, turned very, very positive with regards to crypto, it really seems that the tensions in macro and the trade wars that we're currently facing have a strong impact on the crypto ecosystem as well. And hence we see price contractions, but also ETF outflows from these crypto ETFs.
We have discussed this last time already a little bit, and I want to emphasize that this is no investment advice, but I mean, the Bitcoin or crypto in general has always been very macro driven. And I would say Bitcoin itself and the crypto industry show in my opinion, currently very strong fundamentals. When you look at the speed of innovation, the engagement, the number of new clients, the usage of stablecoins, all these kinds of things, while the prices go directly in a different direction, in my opinion, mainly driven by macro factors. So as said, no investment advice, but I think it is. I mean, it has recovered a little bit already, but it is a good opportunity at the moment to enter the market at a reasonable price, since we have corrected from more than 100K now to a bit more than 80K.
Yeah, and similar developments, we've also seen the price of Ether, similar ETF outflows here. But the only thing that I want to bring up in the Ether and Ethereum market update here is that the roadmap for the ETH developments in 2025 has been more specified and more clearly articulated. And we've covered it already in a couple of past episodes that Ethereum might be in a midlife crisis, so to say, where the developments are not that clear to many investors where it's really heading to. And I think the core developers and the Ethereum Foundation listen to the market and now really wants to put a focus on scaling. So really to bring out scalable layer one, inclusive of the continued focus on bringing out layer two volume as well. So that's quite interesting. And I think over the next months, there's going to be increased communication on that one as well. Maybe we also dive a bit deeper on these interesting developments in the Ethereum ecosystem. And last but not least, we also brought two other market developments that were noteworthy to our mind or to our view. The first one is an acquisition from Kraken. They acquired a NinjaTrader, or aim to acquire NinjaTrader. And if that deal goes through, it would be the largest acquisition of a crypto company of a sum of 1.5 billion. So even larger than the recent acquisition of Bridge by Stripe in the stablecoin area. And NinjaTrader basically offers products that allow investors to speculate on price movements in various asset classes. So not only crypto, but also indices, metals, crude oil, and government bonds. And what's quite interesting here is that the platform, so NinjaTrader, has a futures commission merchant license, so from FCM, which is registered in the US with CFTC. And this opens the door for Kraken for regulated derivatives trading in the US market, which is clearly also a move into traditional markets from these crypto players.
Yeah, it's a testament to the size of the market, right? Because even if you compare it to Stripe, it was let's call it now a traditional financial institution, or let's say institution from the traditional financial system, acquiring a crypto-based startup, let's say, for I believe it was 1.1 billion. But now it's actually a crypto company acquiring another crypto company for 1.5 billion. So as a testament to the size of the market and these big players like Kraken, of course.
And the other noteworthy news, we've talked in the past quite significantly about the Ripple case. And basically the chapter has been closed now. So the SEC basically drops all allegations and all fights and battles against Ripple. So the legal case, which has been running for 4 years already, has been closed. And Ripple basically agreed to pay now 50 million in a fine and therefore let the case be dropped. And for Ripple, it's a big win, and clearly also for the industry, because the case was about the fact that the SEC, the former SEC management and staff, believed that Ripple engaged in the sale of a security, which is the XRP coin that they issue, and therefore is seen as a precedent for the wider crypto industry that coins like XRP are not a security and that they did not engage in securities sales here. So these are the two noteworthy market development updates that we wanted to bring. But without further ado, I think let's jump into our focus topic, which is basically the infrastructure adoption in institutional DeFi or TradFi adoption of DLT. And Alex, I think in the panel on the crypto asset conference in Frankfurt this week, this was also a big topic here. Maybe you can also share a bit of a background what has been discussed and what your views are on this in this area, what we saw in the market.
Yeah, not only on one panel, but it felt like the whole conference was focusing on the topic infrastructure, and also discussed with the organizers. And they told me that they had 1 or 2 infrastructure panels planned, but then everyone, also the sponsors, they all wanted to sit on those 1 or 2 infrastructure panels. So in the end, I believe they had probably like 10 infrastructure talks or panels, and I was on one, which had the name From Legacy to Ledger, how digital asset infrastructure is transforming markets. And yeah, I think this shows very hot topic at the moment, infrastructure. There were people from custodians there. Simon Saiter was there, who has now recently joined AllUnity. That's maybe also noteworthy. Former head of digital assets from Haug Aufhäuser Lampe is now joining the stablecoin company AllUnity. And it was an interesting discussion, but I thought I'd use this as a, let's say, inspiration also for our news episode today, because Manu, I think we realized that quite a few of the news that we are going to discuss today also fit into that topic. And I mean, one main comment I made during that panel was that I kind of see 2 trends at the moment that foster the growth and the adoption of blockchain or DLT as an infrastructure for the financial markets. And those 2, let's say, trends start from different sides of the spectrum, I would say. So we first have the, let's say, native DeFi players moving closer to TradFi via institutional DeFi, which is really gaining momentum and creating permissioned setups that basically aim at enabling regulated financial institutions to use DeFi applications. So that's like one trend I see. And then the other trend is more driven from the traditional financial industry, which tries or is using more and more blockchain technology or distributed ledger technology as an infrastructure for their applications. This is why I said it's starting from the other end of the spectrum. This is usually more on permissioned blockchains, permissioned setups that are slowly being opened up in a way, while of course the native DeFi players, they start on public permissionless setups and are permissioning it more and more. So 2 trends moving a bit closer together, or at least in the same direction, and I thought that would be a good topic to discuss today.
And they move in the same direction in the sense that they get closer to each other, right? Because on a spectrum of very siloed TradFi institutions and very siloed TradFi data setups and infrastructure setups, this is on the one side, and public permissionless DeFi is on the other, and they move closer to each other, right? Because as you said, the crypto players include, we're going to talk about it, or offer some permissioned setups, so for example, permissioned liquidity pools and so forth. Whereas on the TradFi side, we do see some developments to move from bank-centric blockchains into shared ledgers, but then also eventually into some public permissioned setups, right? So it's quite interesting how also the TradFi moves rather into the public domain now.
Yeah, I mean, let's make specific examples. And we have now already mentioned the word permission, and let me start with the DeFi side. So I see 2, now only talking about the DeFi side, 2 different ways of permissioning what that's happening. On the one hand, we have a permissioning at the level of the validators of a blockchain. So who is actually validating transactions? And the problem for traditional financial institutions, why they don't feel comfortable using public permissionless blockchains as an infrastructure, is because they say, I do not know who validates my transaction. And it's sometimes called the North Korean hacker problem or whatever, that you can't be sure that if I do a transaction on Ethereum, for instance, that the validator that validates my transaction is a North Korean hacker, and I would basically pay that North Korean hacker transaction fees, which is of course an absolute no-go.
Or in general, the North Korean validator, right? You wouldn't want to pay any validation fees or any gas fees to anybody sitting in a sanctioned country, for example.
Correct. So one thing that these, let's say, more DeFi native players try to do is they try to permission the validator set. And one example for that is Converge. Converge is a blockchain, a new layer 1 that has been announced by Ethena and Securitize. So Securitize is the partner of BlackRock, among others. It's doing the BlackRock Biddle money market fund. And Ethena is, of course, the issuer of the USDE stablecoin. And they are designing or have designed a layer 1 exactly for institutional needs by permissioning the validator set. So when you use this blockchain, you can be sure only, let's say, KYC validators from the, let's say, traditional financial institutions or crypto exchanges are going to be the validator for this blockchain. What does this blockchain try to achieve? It's in particular targeting tokenized real-world assets. And it's of course interesting to say, do we need another blockchain for that, right? I mean, of course, Ethereum dominates at the moment, but Ethereum dominates, to be frank, only in stablecoins and of course any crypto native assets like NFTs, etc. I mean, you also have Solana, of course, there. But the real world asset market remains largely untapped until today. So that's exactly where Ethena and Securitize want to, let's say, enter the market here in that niche by offering, in particular for tokenized real-world asset, a platform. And I believe it's a smart, I mean, it's definitely something that we need because Ethereum is not catering to the needs of institutional players the way it's set up at the moment. So it's definitely something we need. Not sure if those two players will be the ones that create this one blockchain now that everyone is using. But it's definitely a smart idea to start something like that.
Yeah, in this direction of a public permissioned network, it's quite interesting. There's also a development from the TradFi space, right? So, for example, the Canton network, where there's also news that now Goldman Sachs, Moody's, and the Hong Kong FMI services become part of a they call it Global Synchronizer Foundation, which is basically a governance body linked to the Canton network. And the Canton network they also call it public permissioned network from Digital Asset, which has this digital asset blockchain technology and coding language via which financial instruments can be orchestrated. And we see some members that already use digital assets, so for example, Broadridge, for their intraday repo platform, where actually $1.5 trillion on monthly volume is settled in those repos already. Then Euroclear uses it, SBI Digital is part of it, HKMA in general, so Hong Kong Monetary Authority. They're all already part of this governance mechanism. And BNP Paribas, Deutsche Börse, Goldman Sachs, HSBC, they all use this technology. And the idea is somewhat similar, right? So you have a public network, or in this case, Canton basically connects local networks that are hosted by individual institutions and therefore allow interoperability between those local networks, but in a permissioned way. So you need to know who is part of that validator set, right? And who can ultimately also issue funds on that. So from two different sides of the ecosystem, you see a move into a similar way, I would say.
Yeah, and I mean, one thing is the permissioning of the validators of the blockchain, but what Canton is also doing, of course, or at least it's always difficult to speak about the technology because you can, of course, build different applications on top of it. But what's usually also done is that also the participants are permissioned, right? So it's not a public blockchain in the sense that everyone can just hop on there and buy a tokenized money market fund from BNP, for instance. So these are fully permissioned systems. And now jumping back to the let's say DeFi space, we also see these kinds of tendencies there. And one example for that is an announcement by Coinbase. They have announced the so-called verified pools, and these verified pools are basically also fall into that category of institutional DeFi, and they are now not permissioning at the validator level, they are permissioning at the, let's say, call it participant or user level. So verified pools are basically curated liquidity pools, you could say. So just a liquidity pool where you can, for instance, trade USDC versus Bitcoin, for instance. And curated here means that you have to run through a KYC process at Coinbase before you are allowed to join the pool. This whole thing is running on Base, so the layer 2 from Coinbase, which of course at the moment is also still relatively centralized. So you could even say, well, even the validator set is still kind of centralized here at the moment. But the long-term strategy of Base is really to become decentralized. So here you would have a setup where the technology is actually decentralized. So you don't permission on the validator level, but you permission let's say one layer above at the user level. And Coinbase has even built technology around that. They have an in-house KYC layer called Coinbase Verifications, which links identities to wallet addresses. And apparently also Uniswap v4 has certain functionalities in its smart contracts to enable these permissioned setups. And I think it's quite smart from Coinbase and interesting what they are doing, right? They, of course, have started as a fully centralized company crypto exchange, 100% permissioned KYC, and they are opening up for that decentralized ecosystem more and more. And they are really building a bridge between, let's say, the centralized ecosystem and DeFi with their Base, now these verified pools, institutional DeFi. So it's quite interesting to see what's to come from Coinbase.
Yeah, in that bucket, we could also see another move from the TradFi space, right? So what we see is that BX Digital has been granted a license by the FINMA, which is the Switzerland's financial market, which is the Swiss financial market regulator. They granted a license to provide a stock exchange, so a asset exchange run on public permissionless blockchain systems, right? So this is somewhat similar, I believe, as 21X, which already has received the license in the DLT pilot regime in Europe, where ultimately, anybody in this case, so it's not focused on institutional clients, where anybody can also participate in trading of digital assets and tokenized securities. Here, BX Digital, which is from the Börse Stuttgart digital exchange subsidiary, it's really focused on institutional clients, and therefore there's also some sort of permissioning on top of a public permissionless network, right? So they, I expect, and this project will only go live in a couple of months, but I expect also on, as you said, the application layer, permissioning, who's ultimately able to interoperate with the smart contracts that BX Digital uses in order to provide trading of, in this case, tokenized securities, right? So here in this case, a TradFi player adopting this technology and providing a permissioned application on top of a permissionless infrastructure.
Yeah, and one main driver of all these development is, of course, regulation. And you've already mentioned the DLT pilot regime that we have in Europe. There's an equivalent regulation in Switzerland that now allowed BX Digital to make that move. Of course, we have also the markets and crypto assets regulation in Europe. We have probably soon to come stablecoin regulation in the US. And this is, of course, driving a lot of these movements, because you realize when you enter that, let's say, regulated financial space, which you automatically do when you want to tokenize real world assets, that you need some form of permissioning. I would still hope that we end up with the permissioning only at the user level and not at the infrastructure level, because this enables so many more innovative, interesting applications if we kind of keep the infrastructure permissionless and only then permission and control and apply regulation on top of the infrastructure. As much as we don't regulate actually the internet and the protocols that are used there, it would be great if we could find a setup, a regulatory compliance setup that allows us to avoid regulating blockchain-based infrastructure setups.
Yeah, and that notion also came out in another project that has been announced, UBIX, basically a stablecoin clearing protocol by an interesting character, Tony McLaughlin, from formerly at Citi. And Tony McLaughlin is interesting because he's basically the brain and the thought provider of RLN, so the Regulated Liability Network. You could also even say even of Project Agora from the BIS, and has been a major person in the tokenized deposit space, who now turned into and I quote here from his LinkedIn, stablecoin maximalist. So he's really...
Wasn't he always super critical about stablecoins? I can still remember when he worked on the RLN, because I was already kind of working on AllUnity, and he was always very critical about stablecoins, that it's not going to work out. Maybe I don't want to misquote him here, but I have that in mind.
I mean, he definitely switched sides from tokenized deposits to stablecoin maximalists. I believe he still believes that tokenized deposit makes sense. However, the argument that you just gave on permissioning level on a permissionless infrastructure, he also brought up, right? So his project, UBIX, is basically a clearing system for stablecoins, and he treats or compares stablecoins basically to checks, to digital checks, and UBIX shall become a digital check clearing system, you could argue. And I think it's a quite interesting analogy that he's been putting up, because ultimately a check is also a claim against an issuer, and you wouldn't even need regulation on the issuer of those checks. But what is important is that you can always clear those checks, right? So if you receive a check against a bank, you don't even start to distrust that check. You know that you're going to end up having that money in your bank account. And that's exactly what this UBIX clearing network shall provide. So it's a bank solutions, or a solution that provides or helps to provide solutions for banks to clear out stable coins and therefore defund the funds on bank accounts, and therefore clearly also scale up the use of stable coins here. And I listened to an interesting interview with him where he also brought up exactly what you were saying, Alex. So ultimately, private blockchains have a scale up and a boot up problem where you have to convince users to really engage on those private permission networks, especially if they are only bank-centric, which we've seen in the past quite a lot. This is a big challenge, right? Because why would, for example, another bank participate in, let's make it more digestible at a, Citi blockchain or a JP Morgan blockchain. Therefore, for example, we also see that Goldman Sachs wants to spin off their bank-centric blockchain and provide a shared infrastructure. And we see quite a few shared infrastructures now, right? So there's the Global Layer 1 initiative from Fiat, for example. There's the Guardian Wholesale Network, a Project Agora, Partior. They are all bringing out shared infrastructures, shared blockchain infrastructures. But here, Tony McLaughlin also states, look, there is already layer 1s available. They're called public blockchains. Let's use those because it's very easy, cost efficient to connect to these, right? So that's also been a very interesting shift from a player that has always been focusing on private permission networks, tokenized deposit solutions, into a stablecoin maximalist on public permissionless networks.
Yeah, so and maybe let me announce an hopefully very cool episode we're going to record soon with Fabian Scheer, professor at the University of Basel, on exactly that topic, private versus public permissionless ecosystems, and what works, what doesn't. Fabian has written a research paper for the European Commission on whether you can use public permissionless blockchains for financial markets. So looking forward to that conversation. And it was also like this stable coins versus tokenized deposits, public versus private, was definitely also a focus during the Digital Euro conference this week in Frankfurt. So in almost every panel, it felt like that this topic came up because, of course, stablecoins, lots of momentum. But then at the same time, there were, of course, also representatives from traditional financial institutions, also JP Morgan, Kinexis, who work on tokenized deposits. Partior, for instance, was also represented. And yeah, to be seen. I mean, in particular at the stablecoin front, we of course see a lot of momentum at the moment. In particular now in the US, Donald Trump supporting US dollar stablecoins a lot, together with his Treasury Secretary Bessent. They have announced that they want to push the US dollar stablecoin development to defend the international role of the US dollar as a reserve currency, and Trump has said he expects a draft for a stablecoin bill on his desk before August. And there are actually already bills debated and even voted on in the Senate and in the House. So the Genius Act, that's the one from the Senate, has been voted on. It has passed the vote in the Senate Banking Committee, and the Stable Act in the House is a bit earlier, I believe. And what I find interesting in the US is that also central bankers support stablecoins. So Christopher Waller, he's a part of the board of governors of the Fed. He has also, let's say, was very positive about stablecoins. And I think that's the difference between the situation in the US and in Europe, because it feels a bit like in Europe, our answer to the US dollar stablecoin dominance and the support from the government is now, yes, but we have our digital euro, right? The retail CBDC from the ECB, which, and Amano, I will rely on you to predict that, which will probably only come in a couple of years. And we have discussed this last time already, so I don't want to go into too much detail, but I'm a bit worried about the general stance of regulators, politicians against stablecoins in Europe, which is rather negative, versus what's happening in the US at the moment.
Yeah, and in the US in general, the legislation and regulation especially has become much more relaxed with regards to banks engaging in crypto activities. So not only stablecoins, but also in general, so crypto trading, crypto custody, participation in blockchain networks. They can even now validate transactions and become node validator or run a node and become validators. And this is all come from the OCC, so one of the regulators, the Office of the Comptroller of the Currency, which basically released a paper or released a note that there are no specific regulations or licenses required for banks in order to engage in these activities, including stablecoin management and even issuance, right? Of course, there's also some emphasis on risk management involved, that ultimately banks will still have to focus on the risk management that they are already focusing on. You could say the baseline is technology agnostic regulation, right? So the regulation and the risk management expectation that banks already have, they should now also bring up for this new industry here. But it's quite remarkable that the OCC is now shifted again, I must say, because under Trump, under the first Trump administration, there was also a different comptroller of the currency head who was very, very supportive. But when then Biden administration came into force, this was all reversed again. So let's see how long this will take. But in general, they even withdrew from joint statements in the past with other regulators here. So for example, the Fed. And it appears that now banks have much more freedom to engage in all of these different initiatives.
Yeah, and it seems like banks are also using that freedom. We've also talked about SAP 121, that accounting rule that basically made it impossible for banks to offer crypto custody, has been replaced by SAP 122. Right? So they're also able to offer custody now. You already mentioned custody. Manu and I have talked to a couple of big US banks over the last days here at the conferences in Frankfurt. And as said, they seem to use this opportunity. So I expect to see way more of these big US banks that already provide services nowadays for the, let's say, asset management and banking industry, like custody, transfer agency, and these kinds of things, to enter this market. There will be more competition for Coinbase in particular, as currently like the custodian for most of the Bitcoin and ETH ETFs, for instance. So I am expecting the big US banks to enter that space. And of course, I won't name any names with whom I've talked, but you will know the big global custodians. Exciting, because that's of course also important for, let's say, more traditional asset managers to enter the space, since these more traditional asset managers rather use traditional custodians as service providers, and it's not that easy to just switch your service provider. So if now someone like State Street or BNY or BNP Paribas, these players offer also transfer agent services or custody services for tokenized assets, that might lead to a situation where more and more adoption also from the traditional financial ecosystem happens.
Yeah. I mean, one caveat is that this was only the OCC, so the Federal Reserve and the FDIC, which are two other bank regulators. So far, they have not announced that they've relaxed their regulations and their view on crypto activity, but it remains to be seen whether that will also happening. And the two, so Federal Reserve and FDIC, are also a part of the group around Trump. So to develop a federal regulatory framework for digital assets and stablecoins as well. So yeah, definitely something that has been changing. One other piece that is still to be seen, right, whether and how it will be implemented, is the SCO 60 Basel requirement, or the recommendation by the Basel Accord, that ultimately foresees that financial institutions, regulated banks predominantly, cannot ultimately touch public blockchains and hold assets that are issued on public blockchains on their balance sheet. Well, of course they can, but then they have to hold lots of equity against it, as discussed in the past in many, many episodes in this podcast.
So let's quickly mention that anyway, Manuel. So just to make that clear, it says if an asset is issued on a public permissionless blockchain, it would mean for banks, if they hold it on their own balance sheet, right, not for clients, but on their own balance sheet, they would have to back it by 100% capital. So if I hold a stablecoin on Ethereum on my own books as a bank, let's say €100, I would have to hold €100 of capital against it, which is totally nuts, and no bank is going to do that. So it's actually the same as just telling banks you're not allowed to touch assets on a public permissionless blockchain. At least it's not at all scalable for banks to do that business. It's not profitable.
Exactly. And why did I say that it remains to be seen how and if it will be implemented? Well, the process looks as follows: that Basel standards are not legally binding, but basically serve as a global regulatory recommendation. And each jurisdiction, and especially, the US, the European regulator, so European Central Bank, also the UK regulators, really decide then how to integrate them. In the past, they always integrated it. However, we see, for example, from Basel III implementations, that they were originally set for 2015, but in some jurisdictions, actually until now, they are not finally implemented, right? So over the course of 10 years, those recommendations have not been implemented in the way that the Basel Forum actually indicated or suggested that they should be implemented. And therefore, I think this is going to be interesting how the US regulator will ultimately implement those recommendations. The time frame looks as if, or as that by June, for example, in the EU, the European Commission is expected to submit a legislative proposal to introduce a dedicated prudential treatment for crypto asset exposures. Taking those recommendations into perspective, also taking MiCA into perspective. And the final implementation of the Basel standards, including this SCO 60 recommendation, is scheduled for January 1st in 2026 here in Europe. But on the US, so far, I have not seen any news how they aim to implement it.
Yeah, interesting dynamics. I'm really looking forward to seeing how this plays out, because I'm not sure if Europe can afford introducing legislation based on these principles if the US doesn't, right? It would be a huge disadvantage for the European industry. So yeah, and to be frank, I'm skeptical whether the US is really introducing anything that implements these rules in particular. And I just want to mention that because we often speak very positively now about stuff that happens in the US, but there is of course also Trump being Trump, right? And for instance, his indirectly related crypto company, World Liberty Financial, which is run by his sons, has now apparently also issued a US dollar stablecoin. It's called USD1. So, a lot of things that he does is just full of conflicts of interest. And of course, now Trump and his team, they have very, very little incentive to approve anything remotely similar to these Basel requirements, because they would suffer even personally, privately from it. So, and as that Trump being Trump, I'm interested how this is playing out.
Correct, yeah.
Should we maybe mention one last point on this whole discussion, and maybe tying it now back to where we came from? Namely, there are these two trends where the DeFi native players move into a similar or same direction as the TradFi players, trying to make the infrastructure as open as possible, but at the same time usable for traditional financial regulated institutions. Something that became really clear, in particular in Europe, and in this case in Germany, is that as soon as you have these regulatory frameworks, pure DeFi will be difficult to exist, right? Because there was always this hope that, yeah, maybe you have the regulated part, but then there's also this completely unregulated DeFi. It seems like this is going to become a very, very small niche, if at all. And there was one action, in particular here from BaFin, that has imposed immediately enforceable measures against Ethena. And we have talked about Ethena already, the issue of the USDE stablecoin. And BaFin has now decided to freeze the asset reserves related to that stablecoin because this stablecoin is apparently not complying with MiCA. And they have restricted the management's control over the reserve assets. They have closed Ethena GmbH, so the German entity of Ethena. They have blocked their website, and they have appointed a special supervisor to monitor compliance to all these measures. So pretty serious, I would say, allegations against Ethena and a complete closure of that business. And that's, of course, also a consequence of introducing regulation. I've taken a look at the managing director of the Ethena GmbH in Germany, because I thought, look, it's pretty risky to kind of be the representative towards BaFin for such a business, because of course you are aware that it's probably not compliant with MiCA. And I won't name any names, but he has a very, let's say, interesting CV. He was first at Nuri, that was a German broker that closed down a business because they were involved in the Celsius lending and lost some money there. Then he was at Bankhaus von der Heid, which also closed down. And now he's with Ethena, which now also is closed down, at least for now. So I just thought that's an interesting way to kind of do your business and move from one to the next struggling. And I'm not even saying that it's his fault, right? But moving from one to the next struggling company before it's closed down.
I mean, it's definitely clearly an interesting concept of having a decentralized stablecoin. I think yesterday at the DEC, so the Digital Euro Conference, there was a decentralized euro stablecoin announced, where ultimately crypto can be pledged, and then a smart contract basically creates a stablecoin as a liability of that smart contract, which can be then used. So somewhat similar to the concept of DAI, or here in this case also Ethena. Let's see how those structures and how those completely decentralized and algorithmic stablecoins, you could argue, will survive in the era of stablecoin regulation, which we definitely will enter, right? So we already have one in Europe with MiCA. All around the world, there's developments, and in the US, very soon likely as well.
Okay, so Manu, while you are very close to your weekend already, I have to start working soon. So I see you have a couple of more news here. Let's maybe pick one or two of those and then slowly wrap up.
Yeah, sure. I mean, what we also provided or can provide is a very quick rundown of stablecoin news, and there have been quite a number. As you already mentioned, for example, Trump has also now mentioned or announced that they're going to issue a USD1 on Ethereum and on Binance chain. Fidelity has stablecoin plans. So Fidelity...
Sorry, Manu, the interesting thing is they haven't even announced it, right? So World Liberty Financial didn't announce the Trump coin. It was CZ in a tweet, so the former CEO and co-founder of Binance, who mentioned it, that there is now this coin. And then they just later said, oh yeah, true, it's our coin. But apparently you can't trade it yet, this USD1.
Yeah,
and there was no official announcement around it. It was weird, to say the least.
Interesting, yeah. And full of conflict of interest, as you stated, yeah. But yeah, I mean, the list continues, right? Fidelity, which is a huge asset management player, they also announced that they want to issue a stablecoin. And I mean, they already have a big track record in the crypto and tokenized security space. So, for example, they issued a US dollar denominated money market fund. Expanded their offering over the last years significantly, and now want to also issue a stablecoin. Then OpenAI and Visa have announced that they want to issue a stablecoin on the World Network, which is basically the network of OpenAI, where the World ID with these orbs of OpenAI is issued on as well, and they really want to foster stablecoin adoption in the regulated traditional economy, where then these stablecoins can also be used for settling of real-world transactions, and not even financial markets, but really real economy transactions. There was also news that ICE, which is the parent of the New York Stock Exchange, plans to use Circle's USDC, but also the USYC money market fund that they have acquired. So that's also quite significant because this would be then wholesale adoption in the regulated capital markets and financial market space. And last but not least, there was an interesting announcement that Iron, which is the startup of the team that is quite known here in Germany. So Maximilian von Wallenberg, Peter Großkopf was also part of it. They had their now I forgot the name, how it was called, the wallet that they then sold to Jupiter. Yeah, so it was a Solana wallet, and then they sold that to Jupiter. They then planned to build a blockchain bank. We even had Peter Großkopf in the podcast here, so happy to link that in the show notes as well, that episode, but then shifted basically to a stablecoin technology firm that basically provides APIs for stablecoin adoption in the real economy and in treasury and at corporates ultimately. And that company, Iron, was bought for apparently $100 million by MoonPay, who also now want to have that capability. So to have an API tech stack for managing and processing stablecoins. So the momentum in the stablecoin industry is not stopping. It's extremely hot at the moment. And lots of players are now looking into this new space in spite of the looming stablecoin regulation in the US as well.
Yeah. So the wallet was called, or the company at least was called Unstoppable.
Of course.
Yeah. And impressive numbers. I mean, here 100 million. We have mentioned Stripe before, 1.1 billion. You always have to be aware, of course, that these of Bridge, acquiring Bridge. You always have to be aware, of course. I don't have any, let's say, insights at all. But these are usually share deals, right? So they're not actually transferring 100 million in cash. This is often paid by shares. I'm pretty sure that was also the case for in the Stripe deal. But nevertheless, impressive numbers. Manu, let's maybe wrap it up. And we always have, as a last part of our news episode, we share interesting links to interesting reads, videos, whatever. What have you brought today?
I've brought I must say, impressive and very interesting, very long speech by the ECB, or ultimately here in this case by Philip Lane, who is member of the executive board of the ECB. And he basically provides the rationale for why a digital euro is needed. So even though you might not agree to the argumentation that Philip Lane is bringing up, it's an extremely interesting read, I would say. It's a very long speech, but I can strongly recommend to go through it. It basically covers reasons for retail CBDC, reasons why retail CBDC, so the Digital Euro project, is needed in the area where we see lots of momentum in stablecoins, platform-based payment systems, and so forth. So I can only strongly recommend that as a monetary system 101 and digital money 101.
Cool. I have brought something that ties back to what we have discussed in the beginning around Coinbase and its on-chain strategy, because Coinbase has published an Ethereum validator performance report. It's a very quick read, but I found it really interesting and the numbers quite impressive. So Coinbase is running 120,000 Ethereum validators. The staked ETH via the Coinbase wallet is at 3.84 million ETH, which means that 11.4% of total staked ETH comes from Coinbase, which I find quite impressive. Not necessarily something that we want to see, right? Because it means, of course, to a certain extent, too centralized probably. But still, I mean, Coinbase is doing a pretty impressive job there, sharing other statistics around their validator business. So interesting, quick read for those of you who are interested in these topics. All right, let's wrap it up. Manu, thanks for dialing in from Singapore. Thanks to all of you guys, dear listeners, for listening, for dialing in. We are going to hear each other again next week. Please do not forget to like and share this episode. And I want to emphasize that in particular, since we have switched to English, we have, of course, unfortunately lost a couple of our dear German listeners. And now it's time to gain, of course, gain additional listeners from the international space. We are, of course, for sure going to focus also in the future mainly on the, let's say, European, German, Swiss, Austria, France area. So if you're interested in these kinds of things and maybe also a European view on what happens in the US and in APAC, this is the right place. This is the place to be. So thanks a lot for sharing this podcast, for informing your friends about it.
And recommend it. That would be great. Thanks a lot for tuning in.
All right, have a good one, and then see you or hear you next week. Bye-bye.
Bye-bye.
The views expressed are solely the personal opinions of the hosts and are provided for informational purposes only. This podcast does not offer financial or investment advice. Always conduct your own research and make well-informed decisions before investing. Please be aware that the hosts and guests may hold cryptocurrencies or digital assets discussed in this episode.